If you are looking at the 2026 market pullback and asking me whether this is a crash or a buying opportunity, I am going to tell you something you may not like at first. That is not the first question I ask. The first question I ask is much harder and much more useful. What kind of owner are you when prices stop flattering you? Because that is what a market like this reveals. A rising market hides a lot of sins. It hides weak balance sheets. It hides sloppy thinking. It hides valuation mistakes. It hides the difference between a business and a story. It hides whether you are investing or simply borrowing confidence from everyone around you. Then the market pulls back, oil jumps, the war noise gets louder, rate cuts disappear from the script, and suddenly the same people who thought they were long-term investors discover that what they really were was comfortable investors. That distinction matters more than any chart on your screen. Right now, that is the real event, not just the decline itself. The separation between the people who know what they own and the people who only knew what was going up. The separation between portfolios built on durability and portfolios built on excitement. The separation between those who prepared for a reset and those who confused a strong market with proof of their own discipline. I have lived through enough cycles to know that the market almost never asks the question in a polite way. It asks it with red ink. It asks it with volatility. It asks it when people are already nervous and still pretending to be rational. And that is exactly the environment we are in now. Let me say something clearly at the start. Not every pullback is a crash, not every dip is a bargain, and not every expensive stock that finally falls has become cheap just because it is down. That sounds obvious, but in real time people forget it. They see pain and think opportunity, or they see pain and think doom. Most of them never stop to ask the only thing that matters. What is the market actually repricing? That is the question I care about, because when you understand what is being repriced, you stop behaving like a tourist. You stop reacting to the noise and start thinking like an owner of businesses. What I see in 2026 is not a mystery. It is not even particularly exotic. It is what happens when an overextended market runs into a change in the cost of certainty. For a while, the market was pricing the world as if growth would stay generous, AI enthusiasm would stay untouchable, inflation would calm down on schedule, the Fed would eventually ease, and all the popular growth names deserved to be treated as if tomorrow was already guaranteed. That was a wonderful fantasy. It was also expensive. When the fantasy gets too expensive, the market does not need a catastrophe to correct itself. It only needs a disturbance large enough to make people do the math again. That is where the war matters. That is where oil matters. That is where the interest rate path matters. That is where valuation matters. And that is why you should not look at this environment and ask, should I buy the dip? You should ask, what exactly was the market pretending not to price a few months ago that it is now being forced to price? That is a much better question. Now, I want to frame this in the language I trust, most business language. If I buy a business, I do not buy the chart. I buy future cash. I buy resilience. I buy the right to sit behind a machine that produces earnings, reinvestment power, and optionality over time. The stock market is useful only because it occasionally offers me a chance to buy that machine at a silly price. Sometimes the silly price is too high because people are euphoric. Sometimes the silly price is too low because people are scared. My edge, if I have one, has never come from predicting fear perfectly. It comes from refusing to let the crowd tell me what a business is worth, just because the crowd has decided to become emotional this week. That is why the current market does not scare me in the way it scares many people. It interests me, but it only interests me through a particular lens quality. I want to say that word again because in a market like this, it becomes the dividing line between intelligent opportunism and foolish bargain hunting. Quality, when people hear buy the dip, many of them hear a slogan. I hear a filter. The filter says this: is the business real? Does it have a strong balance sheet? Does it produce real free cash flow? Can it finance its own future? Can it survive a slower economy, a tighter credit environment, and a longer period of uncertainty without needing the kindness of strangers? If the answer is yes, then a lower price may become very interesting. If the answer is no, then the lower price may simply be the first step on the way to a much lower one. A falling stock is not a thesis. It is a falling stock, that is all. Now let me tell you the first mechanism that matters in a market like this. I call it valuation gravity. There are times when a market is not really growing into its prices. It is simply getting more comfortable with paying absurd prices for familiar names. That is what happened in a number of large growth businesses heading into 2026. People became so willing to pay for AI, for scale, for brand familiarity, and for quality at any price. That price stopped being treated like part of the investment equation. It became an afterthought. That is always dangerous. A wonderful company can still be a poor investment if you pay too much for it. I have spent most of my life trying to teach people that one lesson: you do not improve an overpayment by admiring the product more. You do not justify a rich multiple by repeating the company's name with greater enthusiasm. If a great business is priced for perfection, then even a very good future can disappoint the stock. That is the cruel arithmetic of overvaluation. You can have the right company and the wrong entry point and spend years discovering the difference. What happened in this market was that a number of beloved names stopped being priced like businesses and started being priced like inevitabilities. That is why the current repricing feels so rough to people. Not because all of those businesses are bad. Many of them are excellent. But excellent businesses bought at arrogant prices will still remind you that gravity exists. That is what we are seeing now. Gravity. The second mechanism is what I call rate path whiplash. A lot of money went into growth assets on the assumption that the next part of the movie would include easier policy, lower rates, cheaper capital, a friendlier backdrop for long-duration growth stories. That was not an irrational framework at the time. The problem is that a framework is only as good as the world's willingness to cooperate with it. Then uncertainty in the Middle East intensified, oil moved higher, inflation expectations became less comfortable. The idea of near-term cuts started fading. The market that had been leaning toward relief suddenly had to consider the opposite possibility: not fast relief, potentially no relief, maybe even a more hostile path than people were preparing for just weeks earlier. That changes everything for risk assets. When you own a company whose appeal depends heavily on future earnings far out in time, the discount rate matters. People like to talk about innovation and ignore the denominator. The denominator still matters. When the cost of money stays high or stays uncertain, the market is less willing to pay fantasy multiples for growth stories. That is not ideology. That is math. A lot of portfolios loaded up on growth under a rate cut story. Now they are being repriced under a rate delay story. That is a different game entirely. And if you do not understand that, you will look at your screen and think the market is acting irrationally. It is not irrational. It is merely less generous than it was. The third mechanism is the balance. Sheet test, this is where weak thinkers get exposed. In good times, people love narrative. They talk about total addressable market. They talk about disruption. They talk about optionality and ecosystem and secular tailwinds and every other phrase that helps them avoid opening the financial statements. Then the market gets rough. Then suddenly cash matters, debt matters, free cash flow matters, the ability to self-fund matters. Because when conditions tighten, businesses do not survive on adjectives. They survive on resources. This is why I always return to balance. Sheet strength when the market gets nervous. A company holding enormous cash, modest debt, and strong free cash flow is simply playing a different game from a company that needs friendly capital markets to continue its dream. One company can be patient. The other company must be lucky. I prefer patient businesses in a period like this. Patience becomes a competitive advantage. When slower growth or a recession scare begins to creep into the conversation, the companies with real cash and real cash generation can continue investing, can withstand pressure, can buy back stock intelligently, can acquire weaker players, can survive a long winter. The companies without those traits become hostages to the environment. That is why quality matters more now than it did when everything was rising. A bull market makes weak companies look tolerable. A tougher market reminds you that tolerable is not a category worth paying for. Now let me say something a little sharper. If you are still reaching for highly speculative names in an environment like this just because they are down a lot, you are not buying value. You are auditioning for disappointment. There is a big difference between temporary markdown and permanent weakness. Quality businesses at better prices are opportunities. Unproven businesses with collapsing sentiment are not automatically opportunities. A lot of investors confuse the two because they do not actually want to buy businesses. They want to buy stories that once made somebody else rich. That is not investing. That is envy expressed through a trading account. The fourth mechanism is what I call the index illusion. This one fools people every cycle. The broad market can look down only modestly, while large parts of the market already feel like a bear market. That is because indexes are weighted and leadership can mask internal damage for a while. So investors look at the benchmark and tell themselves things are not that bad. Meanwhile, individual holdings are down 20, 30, 40%, and portfolios built without structure are already bleeding as if the recession had arrived in person. That matters because it changes the emotional experience of the market. People begin feeling capitulation long before the headline index gives them official permission to call it a correction. That emotional mismatch is dangerous. It makes some investors panic too early and makes others complacent too long. One side says, this is the end. The other side says, the index isn't even in correction, so nothing serious is happening. Both are lazy. A market is not one number. It is a living hierarchy of repricing. Some names get there first. Some sectors get there harder. Some quality businesses quietly become attractive while the headlines are still treating the situation like a temporary mood swing. That is why a serious investor looks under the surface, not just at the index level, but at the internals. Which parts of the market have already paid the price? Which parts are still pretending? Which companies now offer real businesses at reasonable valuations? Which companies still offer stories at insulting prices? That work matters now. More than any market slogan, the fifth mechanism is what I call cold allocation. This is the part people hate because it sounds less exciting than stock picking, but when markets get rough, portfolio design begins deciding the outcome long before your opinions do. I always tell people the same thing. The time to discover you are overextended is not after volatility arrives. It is before a portfolio with no real foundation will get smoked in an environment like this. A portfolio built entirely on the names that recently worked will teach you a lesson you should have learned when times were easier. A portfolio that confuses concentration with conviction is a portfolio begging the market to humble it. So what do? You step back and examine the structure, not your hopes, not your favorite ticker, the structure. How much of this portfolio is high-quality cash-generating businesses? How much of it depends on cheap capital? How much of it depends on a specific macro forecast being correct? How much of it is genuine diversification? How much of it is 5 versions of the same bet? How much of it gives you ballast? How much of it gives you optionality? This is why broad ETFs become attractive in a market like this. Not because I have suddenly become allergic to individual stocks, but because balance matters. A dividend-focused fund can bring a certain kind of quality and discipline. A large cap concentrated index fund can give you exposure to the strongest major businesses without asking you to pretend you know which single one will be the hero. A broader momentum or diversified quality basket can help you participate while reducing the danger of being wrong about one name. People underestimate what this does psychologically. A balanced vehicle can keep you in the game when an unbalanced portfolio would force you into a bad emotional decision that matters a lot. The sixth mechanism is what I call the nibble protocol. I am not a fan of theatrical all-in behavior in a market like this. If the world is uncertain, valuations are improving but not universally cheap, and the path of rates and geopolitics remains unstable, then the right temperament is not frenzy. It is patience with appetite. That is the posture. Patience with appetite. You do not need to choose between panic and recklessness. You can acknowledge that conditions may get worse before they get better, and still buy excellent businesses when they become attractively priced. You can build a cash position and still deploy capital. You can nibble That word matters. Nibble here, nibble there. That is how a mature investor acts when the menu is improving, but the kitchen is still on fire. You do not need certainty to begin acting. You need standards. A lot of investors are very weak on this point. They think the choice is between total confidence and total inactivity. That is because they have not learned to think probabilistically in real life. You almost never get to buy wonderful businesses at wonderful prices with no uncertainty attached. The uncertainty is the reason the price is improving. So the goal is not to wait for a perfect world. The goal is to wait for a good enough price on a strong enough business and then act with appropriate sizing. That is what I mean by nibbling. You are not predicting the exact bottom, you are building a position into improving math. That is a very different thing. Now let me bring in the human side because this is where most people still lose. When markets pull back, investors reveal what they were depending on emotionally. Some people were depending on the market to validate their intelligence. Some were depending on it to keep paying for their impatience. Some were depending on it to reward concentration because concentration had been flattering them for a while. Then volatility arrives and all that hidden dependence comes to the surface. This is why I care so much about owning businesses. You can actually explain to yourself calmly when a stock drops and your only reason for owning it was that it had been going up. You have no anchor. When a stock drops and you understand the business, the balance sheet, the valuation, and the role it plays in the portfolio, you can think. And thinking is the rarest skill in a market like this. Everybody else is reacting. Thinking requires distance from the crowd. It requires the ability to look at a falling stock and ask not, why is this hurting me? But what is the market newly unwilling to pay for? And is that refusal now excessive? That is a much better question. The seventh mechanism is what I call recession shadow. We are not in a recession just because people are nervous. But the market does not wait for official declarations to begin repricing. It sees slower growth before the headlines will admit it. It sees lower confidence. It sees tighter financial conditions. It sees the possibility that the next few quarters could disappoint the happy projections everybody used to justify rich multiples. That does not mean a severe downturn is guaranteed. It means the shadow of slower growth is enough to change what the market will pay for certain things. And when that shadow appears, defensive characteristics begin to matter more. Businesses people still use in weaker economies, cash-rich leaders, dividend payers with disciplined services and products that become some of the last things households cut. This is why the quality conversation matters so much. A weak market teaches you that not all earnings are equal, not all growth is durable, not all platforms are safe. Not all secular stories survive contact with tighter money and slower growth. The eighth mechanism is identity. What kind of investor do you become in a period like this? Do you become the man who waits for headlines to feel comfortable again before he buys? That man always pays up for certainty. Do you become the man who buys everything simply because it fell? That man always confuses motion with opportunity. Or do you become the owner who studies the repricing, protects the foundation of the portfolio, upgrades quality where the math improves, uses broad vehicles intelligently, and accepts that the best periods to buy usually feel worse than the headlines say they should? That is the identity question. And markets like this are where that question gets answered. Not in your notes, not in your self-image, in your actions. Now let me tell you what I would do from here. I would not chase speculation. I would not behave as though this is some heroic moment demanding maximum aggression. I would not assume that because certain names are down sharply, they must therefore be bargains. I would start with the portfolio. I would examine every holding and sort it into simple categories. Real quality at improving prices, quality but still not cheap enough, speculative and unnecessary, defensive ballast, diversified vehicles that can keep me sane while I build. Then I would ask one harder question: if this market gets worse before it gets better, which of these holdings will I be grateful to own, and which of them will I wish I had been more honest about? That question can save you a lot of money, because right now honesty matters more than optimism. I would keep some cash, not because I am terrified, because optionality matters. Cash is not cowardice. When valuations are still normalizing and uncertainty is still high, cash is dry powder. Cash is the right to act later without having to apologize to yourself. But I would also buy where the math deserves it. That means businesses with fortress balance sheets, powerful free cash flow, durable demand, and valuations finally coming back within range of reason. It means I would rather own fewer great businesses or strong diversified funds than a pile of exciting mediocrity. It means I would rather buy something with a pristine balance sheet than something with a beautiful story and a begging bowl. That is just common sense, and common sense tends to look boring until it starts outperforming. I would also remember something that inexperienced investors forget. The market often feels worse just before the best opportunities become obvious. That does not mean every bad day is the bottom. It means emotional clarity and price opportunity rarely arrive on the same day. So I do not need the world to stop being uncertain before I begin acting. I need the valuation, the business quality, and the position size to make sense. That is enough. Now let me say something to the person who is still asking, but what if this becomes a bigger crash? It could. That is not impossible. The market wanted a pullback, and it may still want more than it has taken so far. Geopolitics could worsen, oil could push harder, inflation expectations could remain sticky, rate cuts could move even farther away, growth could slow more than people expect. That is all possible. But that possibility does not invalidate disciplined buying. It merely argues for disciplined buying. There is a huge difference. If I know the world may get worse before it gets better, I do not freeze. I scale, I buy in pieces, I upgrade quality, I protect the foundation. I use broad diversified tools where appropriate. I avoid the urge to prove courage by buying garbage. That is the adult response, not certainty, not paralysis structure. Now I want to end with the real lesson, because it is never only about this quarter's decline. What we are seeing in 2026 is a reminder of something permanent. A lot of people love the stock market when it acts like a slot machine for admired names. Very few people love it when it returns to being an auction for real businesses. But I love it much more in its auction phase, because in the auction phase, seriousness is finally rewarded again. Quality matters again, valuation matters again, balance sheets matter again, patience matters again. And those are the moments when owners have an edge over tourists. That is why I do not think this environment is something to fear blindly. I think it is something to read correctly. The market is telling you that fantasy has become more expensive. It is telling you that quality is separating from speculation. It is telling you that rates still matter. It is telling you that geopolitical uncertainty can alter valuation regimes very quickly. It is telling you that the broad market can still look manageable while individual names are already teaching painful lessons. And it is telling you that the next great returns are unlikely to come from chasing what still needs a perfect future to work. They are more likely to come from calmly buying strength at improved prices while everybody else is still asking whether the sky is falling. That is how wealth is usually built, not by avoiding every decline, by using the right declines. So here is the final choice. You can treat this market like a threat to your identity. You can panic. You can freeze. You can keep reaching for speculation because it once made the easiest money. You can wait for the world to feel warm and friendly again and pay much higher prices later for the privilege of emotional comfort. Or you can do the harder and more profitable thing. You can become colder, not emotionally empty, financially disciplined. You can examine your portfolio honestly. You can keep cash without shame. You can buy quality without urgency. You can use broad ETFs intelligently where they improve your foundation. You can nibble where the math improves and wait where it does not. You can stop asking the market to make you feel safe and start asking it to offer you value. That is a very different way to live as an investor. And periods like this are where that difference compounds, not just in the account, in the mind, because once you learn to operate this way, the next pullback does not feel like a personal attack. It feels like what it really is. The market returning for a while to the business of offering actual opportunities to actual owners.